Guys, the Fed is trying to slow down the jobs market to reduce the rate of inflation. Or simply put another way, the Fed is trying to soften the labor market to help them reduce the growth in the rate that prices are currently rising. But guys, the job market is in record-breaking territory. The labor market right now, guys, is red hot sizzling. Now, what I want to do on this video is talk about the labor market and what is happening in this ridiculously strong jobs market right now. Now, the latest jobs report just came out last week, and so on this video, I want to give you a quick rundown of what it said and what it means for each of us. The Federal Reserve raised the Fed funds rate again last week for the 10th straight time in a row, and that brought the federal funds rate to between 5% and 5.25%, which is the highest it's been in nearly 20 years. Now, the Fed has been hoping that the labor market would begin to show signs of loosening up because of these rate hikes. Right now, there are almost 1.6 jobs available for every one person that's looking for a job. So there's lots of jobs that are out there right now, guys. And if you've ever been in a place where you need to find a job, right now is the time, guys, when jobs are almost everywhere. Now, if you're out there and you're watching this and you're out of a job, listen, do what you can to continue to look because there's plenty of jobs that are available out there. Maybe not in your particular area of skill sets that you have, but they're out there, guys. Tons of jobs. We have a really low unemployment rate. The latest jobs report showed that the current unemployment rate is 3.4%, which is the lowest unemployment rate since 1969. Guys, that means unemployment is at a 54-year low right now. And that means the job market is incredibly tight. And it's really a job market that is hard to explain right now, given the fact that the Fed has continued to raise rates over the last year. Right? These things are not supposed to be happening at the same time. Federal funds rates going up and up and up, and the unemployment rate going down and down and down. That's very unusual. And really, it has a lot of economists and the Fed themselves scratching their head right now. Now, normally what happens, guys, is when the federal funds rate goes up and up and up, money is more expensive to borrow, such as auto loans. Ultimately, that trickles down to home loans as well. Credit card usage, right? All of those types of loans, they become very expensive, right? The interest rates go up on them and they become really expensive, typically when the Fed begins to raise rates like they've been raising them lately. And when that happens, people slow down their borrowing of money because people typically don't want to borrow money that's more expensive. Now, I'm not saying they stop borrowing money, but they typically slow that down. And also businesses slow down borrowing money as well, right? And then ultimately the demand for goods and services, that typically goes down. And ultimately businesses, if they want to stay in business, they have to lay off workers, stop hiring so many workers, or simply shrink their labor force that they have. And ultimately those businesses, they lower their prices as well. Prices go down when all of that is in play. All these things normally happen when the Fed raises its rate the way they've been doing for the last year. And that's the usual model, but that's not happening right now. And one of the main reasons that the Fed is looking at this and saying, what's going on, what's happening, is because the labor market has been so tight. And according to the latest jobs report, it's still very tight. Matter of fact, it's getting tighter and tighter. The unemployment rate is going down, lower and lower. It went from 3.6% to 3.5%, and then this month to 3.4%. So here's what happened with the labor report, and here's what they expected. Non-farm jobs, they thought would go up and increase by about 185,000. Well, the non-farm jobs last month went up by 253,000 jobs. Again, the unemployment rate went from 3.5% down to 3.4%. Also, average hourly earnings on a month-over-month basis. They thought average hourly earnings would increase by only 0.3%. However, average hourly earnings increased month over month by 0.5%. And then you had average hourly earnings for a year-over-year basis. They thought average hourly earnings year-over-year would increase 4.2%, but average hourly earnings increased year-over-year 4.4%. So you had all of these expectations from the experts that were wrong, and the labor market appeared much stronger in those areas than they thought it would be. Now, going back to new non-farm jobs. New non-farm jobs increasing by 253,000 last month. To put that in perspective, the previous month, new non-farm jobs increased by only 165,000 jobs. So more new jobs are being created, the unemployment rate is going down, and the average hourly earnings on a month-over-month and a year-over-year basis is increasing. People are making more money. So when people are making more money and the average hourly wage rates are going up by, say, 4.4% like they are on a year-over-year basis, that's not consistent with what the Fed wants to see. They want to see average hourly wages go up at a rate that's consistent with a 2% inflation rate. So that spells trouble to the Federal Reserve, because when wage rates go up too much, too fast, it means people have more money. They have more money to spend. And listen, guys, when people have more money to spend, guess what happens? People spend more money, which ultimately doesn't bode well for trying to see inflation go down. Because when people spend more money, demand for goods and services stays high. And when demand for goods and services stays high, prices typically stay high. That means inflation doesn't go down at a rate that they want it to go down when people have more money and are making more money. And right now, guys, people are making more money, and lots of people are working because of the 3.4% unemployment rate being at a 54-year low. So all of this to say, guys, this overall labor report that we just received raises the chances that the Federal Reserve may continue to increase the federal funds rate. And there may be another hike coming sooner than we may have thought. Now, there are obviously other factors besides the unemployment rate and wages that the Federal Reserve is going to look at to make that determination. When they have their two-day meeting in June, and ultimately at the end of that two-day meeting, we'll have another press conference from the chair, Jerome Powell. We'll see if they're going to increase the Fed funds rate again for an 11th straight time or not. So all of this strong job market is all happening while the economy is actually, guys, starting to lose a little bit of momentum. The overall American economy is not growing at the rate that it was growing. It's sort of slowing down. And we know that there was a third bank that went down last week, and other small regional banks are kind of looking like they may be in trouble. So there's some turmoil that's on the horizon that will affect the federal funds outlook, right? Mortgage rates are also up and over the 6.5 or 30-year fixed mortgage right now. So there's other things that are going to affect what the Fed is going to look at when they ultimately make their decision. Now, let me go back, guys. When I say that the overall economy is kind of slowing down, let me explain that real quick. The GDP increased 1.1% in the first quarter of this year. That represents a slowdown in the overall economy. Remember, GDP is simply the measure of the market value of all the final goods and services produced in a country in a certain given time. Typically, we measure that. We measure the GDP in quarters, right? Every year, 4 quarters. We just came out of the first quarter of this year, and it showed sort of a slowdown in the overall GDP. Now, keep in mind, 2 straight down quarters of a GDP is the textbook version of what we call a recession. So with GDP up just 1.1%, which is barely up, things are actually slowing down in the economy. And many experts are predicting a small recession later this year, what the Fed calls a mild recession. So again, we'll see what happens with that as well. But overall, guys, the jobs report was really not what the Federal Reserve wanted to see. And it really gave me a pause. And I'm sure it gave the Fed a pause as well to say, hey, what's really happening here, right? What's going on and what must we do? Should we continue to put the full court press on raising federal funds rate, or should we look at some other things? Now, if you listen to the press conference from Jerome Powell the other day ago, it was kind of clear that they were thinking about slowing down on these Fed fund rate hikes. But then this labor report came out, right? When this labor report came out, it was kind of eye-opening to the Fed. Now, listen, what should you do right now? What should you be doing right now to sort of say, you know what? How can I get myself prepared maybe for a mild recession down the road? Here's just a few things you should be thinking about doing right now, guys. Get those skills up. Get your skills up to the point where if we do start seeing some large layoffs and the labor market finally breaks and is not so strong, it loosens up, unemployment rate goes up to 3.5, 4%, 4.5%, layoffs start happening. Listen, make sure you have your skills up. right? Make sure you've got that extra certification. Make sure you're in a place to always be in demand in whatever you do. Make sure that you are the person that people go to on the job so they can't afford to lose you, right? That's one thing you can do. Make sure you got your resume together and tight. Make sure that you've got your skills tight and that you're ready to go in case something happens. Now, another thing you can do is simply keep investing in the stock market, right? We're going to see some dips in the stock market. Don't jump out of the stock market. Keep investing. Keep dollar cost averaging, right? Keep purchasing those index funds. Keep purchasing those ETFs, right? Don't stop investing in the stock market. You want to be in the stock market now through any types of low points. You want to be there, right? Because when the stock market begins to turn back around, you want to be there. You want to be in the market the whole time. When it's here, when it drops to here, when it's coming back up here, when it's back up, you want to be in the market the whole time and receiving the benefits of the dips in the market that we may experience coming up. Another thing, guys, is get out of the bad debt, right? If you have debt on depreciating items, debt on auto loans, debt on things going down in value, you want to get out of that debt as soon as you can, as soon as possible, guys. Do what you can to pay off some of the bad debt. Pay off the credit card debt. If you're not paying off your credit cards every single month, start practicing that, guys. That's high interest debt right now that you don't want to be paying. So do your best to stay away from high interest credit card debt. Statistics show, guys, that credit card usage and credit card debt is up tremendously, hitting record highs right now. So we want to make sure that we're not a part of that group that's paying extra high interest on credit card debt. So hey guys, on this video, my goal was to give you the latest updates on what's happening in the labor market with the latest jobs report, and at least give you a few things that you should be doing to combat whatever we may be facing coming up. Guys, smash the like button for me, drop me a comment below, and let me know what you think about this strong jobs market that we're in right now. Good, bad? I want to know your thoughts. And check out a few of the videos I'm going to put right here for more updates on the U.S. economy in plain language. Hey, the best person to take care of the old you is the young you. Take care of yourself and take care of other people. Until the next video, peace.